Welcome back to the Daily Crypto Deep Dive, the show where we don't just follow the headlines, we break them down. Today we're diving into one of the most fascinating and misunderstood questions in the crypto world. What happens when the very last Bitcoin is mined? Because whether you've been stacking sats for a decade or just joined the market this year, that 21 million coin limit is the single detail that keeps Bitcoin's mythology alive. It's the reason investors call it digital gold, a finite resource in an infinite printing world. But now, with over 19.7 million coins already mined and less than 1.3 million remaining, we're reaching the phase where the scarcity narrative becomes reality. The latest halving took place back in April 2024, cutting miner rewards from 6.25 to just 3.125 Bitcoin per block. That event, now firmly behind us, set off the same chain reaction we've seen after every previous halving. An initial period of volatility, miners scrambling to adjust, and eventually a surge in long-term accumulation. We're already seeing the effects today. Supply issuance has slowed to its lowest rate in history, and analysts from firms like Glassnode and CoinShares say the post-halving supply squeeze is quietly reshaping how the entire network behaves. Back in 2009, miners earned 50 Bitcoin per block. That fell to 25 in 2012, 12.5 in 2016, 6.25 in 2020, and now 3.125. By the time of the next halving in 2028, that number will drop again to just over 1.5 Bitcoin. Each step halves the flow of new coins entering circulation, and each time it happens, it makes Bitcoin scarcer and historically more valuable. Dutch analyst Plan B, creator of the stock-to-flow model, has always argued that scarcity is the single greatest driver of Bitcoin's price. And while his earlier predictions of $100,000 targets by 2021 didn't fully materialize on schedule, his framework remains influential. He points out that every halving reduces Bitcoin's inflation rate by half, now sitting under 0.8% annually, lower than gold or US Treasuries. In other words, Bitcoin is the only major monetary asset in the world whose supply gets tighter every 4 years. Since the 2024 halving, Bitcoin's behavior has shifted noticeably. Glassnode's latest report shows long-term holders, wallets dormant for over 12 months, now control more than 72% of all coins, an all-time high. That's both bullish and dangerous. Bullish because it proves conviction is growing. Dangerous because it means fewer coins are circulating, amplifying volatility when large holders move funds. We're also seeing what analysts call the miner adaptation phase. Smaller mining operations, especially in regions with higher energy costs like parts of Europe and Canada, have been forced offline, while industrial-scale farms in Texas, Kazakhstan, and the Middle East are thriving thanks to cheap renewables and surplus power deals. Those survivors now earn less Bitcoin per block, but rely more heavily on transaction fees, which have quietly risen since the halving. Fees that used to represent 2 or 3% of miner income now account for around 10 to 12% in busy periods. That's still not enough to replace block rewards in the long run, but it shows the network is evolving toward a fee-based economy. Still, the looming question remains. What happens when those block rewards finally disappear around the year 2140? Can Bitcoin survive purely on transaction fees? Cathie Wood at ARK Invest believes yes, and her reasoning is simple. As institutional adoption deepens through ETFs, corporate treasuries, and sovereign holdings, the value of the network itself grows. When the monetary premium rises, she said earlier this year, the incentive to secure it will follow. ARK's models now project Bitcoin could reach between $1 million and $1.5 million by 2030, assuming continued ETF inflows and declining issuance. It's a staggering number, but it's based on the same principle that drives gold's market cap. Scarcity plus trust equals demand. Others, like Lynn Alden, take a more cautious tone. She told Bloomberg in July 2025, Bitcoin's supply is predictable, but its demand isn't. The halving events bring attention and momentum, but the macro cycle still dictates how far that momentum runs. Her view reflects what we've seen this year. Despite the halving hype, tightening liquidity, and mixed macro sentiment have kept prices choppy. hovering between $90 and $110,000. Yet every cycle, the floor seems higher than the last. For miners, the changing economics are forcing innovation. Companies like Marathon Digital and Riot Platforms are branching into AI compute and renewable energy credits, using their infrastructure to generate extra revenue. They're preparing for a world where mining alone won't pay the bills, and in doing so, they're transforming Bitcoin mining into something closer to an integrated data infrastructure business. That brings us to the human side of this story. The investors. The closer we move toward the cap, the more owning even a fraction of Bitcoin feels like owning a piece of financial history. Every year, more coins are lost. Forgotten keys, burned wallets, misplaced drives, effectively shrinking supply even faster than the protocol itself. Analysts estimate between 3 and 4 million Bitcoin are already gone forever, meaning the true maximum supply might be closer to 17 million. That's part of what keeps the scarcity narrative alive. And it's why even tiny holdings could matter decades from now. But scarcity isn't a guarantee of steady prices. It can also mean sharper volatility. With fewer new coins entering circulation, each large transaction has more impact. Whale wallets moving even 1,000 Bitcoin can now shift the market by whole percentage points. That's why traders obsess over on-chain flows from old wallets or government seizure addresses. Every movement feels seismic. Speaking of governments, regulation is tightening as Bitcoin's influence expands. The SEC has now fully approved multiple spot Bitcoin ETFs, with BlackRock's and Fidelity's funds leading inflows through 2025. That legitimized the asset, but also tied it more closely to Wall Street. Bitcoin is no longer the outsider. It's becoming part of the financial establishment. And as adoption grows, governments are beginning to treat it as an emerging strategic asset. Nations like El Salvador continue to hold it as treasury collateral, while smaller economies in Africa and Southeast Asia experiment with Bitcoin bonds. In the West, policymakers are debating how to tax staking, ETFs, and custody. Proof that the conversation has moved from, should we allow Bitcoin, to, how do we manage it? This institutionalization has mixed consequences. On one hand, it boosts liquidity and credibility. On the other, it softens the anti-establishment edge that drew early adopters. But if Bitcoin truly wants to become a global reserve asset, this mainstream embrace is unavoidable. Let's pull the lens back to the core question, the so-called supply crisis. Once that 21 millionth coin is mined, there will be no new Bitcoin created, ever. Inflation will hit zero. The only way to earn new coins will be through transaction fees. At that point, Bitcoin will behave less like a currency and more like a digital commodity. Fixed in quantity, traded for utility and status. Some economists predict that by 2014, each coin could theoretically be worth tens of millions of dollars in today's terms. But that's assuming humanity still uses the same economic systems, and that's far from guaranteed. In the nearer term, though, the next 5 to 10 years, the scarcity effect keeps strengthening. ETF flows, institutional custody, and corporate treasury allocations continue to lock coins away for the long term. Glassnode data shows exchange balances are now at a 6-year low, down almost 30% from 2021. Every coin moving off exchanges into cold storage is one less coin available for traders. And that's why analysts like Willy Woo call this era the Great Drain. He recently posted, "We're watching the free float of Bitcoin vanish before our eyes." Scarcity isn't coming, it's here. That's the paradox. The more scarce Bitcoin becomes, the more it behaves like the very assets it was designed to replace. People hoard it. Institutions build vaults around it. Governments debate how to tax it. In trying to make the perfect decentralized money, Satoshi may have created the digital equivalent of gold, desirable, scarce, and ultimately dominated by the biggest players. Yet, amid that centralization risk, Bitcoin's ethos still shines. Anyone, anywhere, can still own a piece. You don't need a broker or a banker, just a wallet, a private key, and the discipline to hold through volatility. That's where self-custody becomes more than security, it's sovereignty. Because as scarcity deepens, control becomes everything. That's why it's worth repeating. If you're holding any meaningful amount of Bitcoin, keep it in cold storage. A hardware wallet like Ledger gives you complete control of your keys, offline, immune to exchange hacks or freezes. A simple step to protect what might one day be among the scarcest assets on Earth. Link in the description below. So what's the takeaway for investors listening right now? First, scarcity doesn't mean complacency. As the supply tightens, markets will overreact to both optimism and fear. Stay disciplined. Second, watch the macro environment. Inflation, interest rates, and global liquidity still dictate demand. And finally, remember why Bitcoin was created in the first place. To build a financial system that couldn't be manipulated or inflated away. We're now 16 years into that experiment, and it's still working. Each halving, each block, each miner who turns on a machine to secure the network pushes us one step closer to that final moment. The last coin. It's a story that will outlive all of us, written in code and verified by time. Drop your thoughts in the comments, follow the show, and leave a 5-star rating if you enjoy these deep dives. This has been the Daily Crypto Deep Dive, and as always, we'll see you at the top.